again, thank you for the chance to talk to you today about the topic of searching for angels in the valley of death. And I'll say more about what I mean by that as we go forward. But I'd like to start with a quick outline for today's talk. And I'm going to start with sort of a macro lens, give you a survey of the overall landscape for venture finance, broadly speaking. And then we'll drill down and take a closer look at UCAN, give you an update on what we've been up to since we were here 3 years ago. And then I'll pull back the lens and take a broader look at some things on the horizon that will impact that landscape both broadly and locally. So to start with the macro landscape, I hope you'll indulge me for just a minute. I'm going to pull in some material that I share with my students in Clemson's MBA program. I've taught a managerial econ course and will teach a venture finance course in the new one-year MBA program at Clemson. And so I try to help the students understand a very broad perspective to start with, both economically and historically. And so the way I do that is I start out by congratulating them on being wealthy. And what I mean by that is not necessarily that they all have a lot of money, but if you think about the perspective of the history of mankind, we are extraordinarily wealthy. This data was put together by some economists that have gone back and tried to look at wealth over time, and I mean a long period of time, like 12,000 years. And you can see that throughout most of the course of human history, wealth has been fairly constant and fairly small. But then something really magical has happened in the last 200 years or so, where you've seen this hyper exponential growth in wealth. And in this chart, it's measured in terms of dollars and GDP, but what we mean by wealth broadly is just access to resources to satisfy our needs and wants as humans. And so the last 200 years has been an amazing time to be alive. And so I try again to set the perspective for these students that we're extraordinarily wealthy. And then we try to dive in to the question of how is it that we came to be so lucky to be so wealthy? Well, we know we live in a world with scarce resources. We've got limited factors of production, finite amounts of human capital and natural resources and capital put together by humans. And when we take those factors of production and figure out how to make more from what limited resources we have, we call that technology, putting those factors of production together to create more of the value that we need to satisfy needs and wants. And then we've had these developments in more modern human history around the rule of law and societies figuring out how to better govern themselves, and particularly around the idea of property rights and private property and giving people the opportunity to own their ideas and their property such that they can then have the incentives to go create more wealth or more value from those limited resources. So you put all that together and you get what Schumpeter called this gale of creative destruction in a marketplace where these ideas and these technologies can come together and create more value and more wealth. And we've seen that happen over the course of the last couple of hundred years, particularly with technologies related to agriculture and transportation and mass production. But at the heart of all that story is a person. And that person, of course, is the entrepreneur. And so I'm here to talk ostensibly about investors and angel investors and how the private capital marketplace works. But this story is really about entrepreneurs. And so I want to keep that perspective in mind as we talk through some of the mechanics of the venture finance process and the landscape. Because at the end of the day, without these entrepreneurs, we don't live in a world with that hypergrowth and wealth, and we don't live in a world that keeps that growth going. So that's the bottom line of the story today. Entrepreneurs create wealth. And we've talked about material resources and satisfying needs and wants. But one of the particular ways we think about wealth today, and particularly in today's economy, with the stagnation we've experienced in the last few years, is around jobs. That's a big part of the conversation economically, politically. And so I'll show you a chart that will highlight what I said earlier about entrepreneurs' ability to create wealth in terms of jobs. If you look at the last 30 years in this country, all net new job growth has come from startup companies 5 years old and younger. So the blue bars in this chart represent those startup firms, 5 years old and younger. The red bars represent firms older than 5 years, and this is net job creation. So while large companies create jobs, they also die and go away and destroy jobs. And the net job creation from those firms, represented by these red bars, is negative, while all the positive growth comes from young companies. And you see that even across recessionary periods, the job creation from startups has been fairly constant over the last 30 years. So again, at the end of the day, if we want to continue to create wealth, we need to support and encourage entrepreneurship because that's where jobs and wealth come from. But entrepreneurs have a very challenging job. They have to cross chasms. Many of you are probably familiar with the work of Jeffrey Moore and technology adoption curves. And it's a very challenging thing as an entrepreneur to move from the early adoption period across what Moore called the chasm to adoption by a broader marketplace, the early majority and late adopters, and to make a technology really persist in a marketplace and give you a viable platform from which to build and grow a business. So the entrepreneur has to face that challenge in the marketplace, but they also have to face a different challenge, which is crossing not only that chasm, but also a valley. And this is where the valley of death comes into the picture. So most of you, if you've been an entrepreneur or you studied economics, you might recognize this chart, and I'm going to call this the cash curve. So on the vertical axis, we're talking about cash, dollars, and on the horizontal axis, we're talking about time. So as an entrepreneur, typically, you've got to burn cash or spend money before you can make money. You've got to invest resources to get your venture off the ground, and so you're going to be in this valley between the time you're starting and the time you pass through negative cash flow to positive cash flow, and we're going to call that the valley of death. And as an entrepreneur, depending on the type of business you're starting, your valley of death may be relatively shallow, it may be relatively deep. And so the dilemma that the entrepreneur faces in the beginnings of their venture is to ask themselves the question, how much money is it going to take, how much cash will it take to fund this valley of death? And then at the end of the day, how many resources, how much wealth can be created once our venture is successful? Because that's going to influence how we fill the cash hole there in the valley of death. So I'm going to use this framework to talk a little bit about the landscape that we operate in. And I like to use a rubric to just help us think about where different capital players play in this marketplace. And I'll use the framework I show here at the bottom, which is not a universal truth, but a generally rough way to think about the stages in the life cycle of a startup company. From the very seed stages, which is when the company's an idea on a napkin and you're trying to noodle over whether or not it makes sense to go into business. The startup stage, where you really start to marshal the resources and put a business together and go to market with that business. The growth stage hopefully happens once you've gotten some market traction and you're starting to get across the chasm and gain adoption for your technology or your business. And then finally, in the later stages of the company's life, it's more mature, more established, and it's a different set of challenges that the entrepreneur faces at that stage. So we'll talk through this framework and think about different capital providers and circle back around to the angels that play in this space. So let's talk briefly about the supply side of what I'm going to call broadly venture finance. So the classic way we like to think about entrepreneurs funding a business, and oftentimes the best way, if you can do it, is the good old-fashioned bootstrapping method. So what we mean by that is the entrepreneur tapping into their own savings, their own credit cards, talking with their business partners, their vendors to give them better credit terms, work with them to give them a little leeway in the early going to provide some cash flow financing for the business. And usually that's a great way to get started. But oftentimes, depending on the type of venture the entrepreneur is starting, those resources may not be sufficient. So the next best source of funds is our friends, our family, otherwise sometimes known in the venture world as the FF&F crowd, friends, family, and fools. Sometimes they love you and they want to give you money, even if you may not necessarily make them money for that. We've also got other sources of funding that may come from public sources. They may be federal grants. They may be SBIR or STTR grants that come through federal agencies to fund certain technologies that those agencies want to see developed and commercialized in the marketplace. The feds also back certain loans, certain types of debts through the Small Business Administration. So those can be early stage funds for companies sometimes, although they certainly are going to require personal guarantees from the entrepreneur. Some folks would say, well, you go talk to a bank. Some of you probably had the experience of going and talking to a bank, and they say, come back when you've got cash flow that's really positive, and we know that you can afford to pay us back the debt that we might consider giving you. So certainly in today's market, banks are not a great source of financing for a startup company. They just don't have the track record and the resources to give the bank the comfort they need that they'll get paid back. But potentially later in the company's life, certainly the bank is an option. So then let's think broadly about what you hear discussed in the papers and the media as private equity. And that's a broad term that can have a lot of different subsets. Private equity, broadly speaking, is just private money rather than public money that's going to buy equity in the entrepreneur's business rather than providing a loan or debt. Private equity can be big funds that buy established companies. We've got one here in town called Azalea Capital. They're a relatively small private equity fund. There's certainly ones that are much, much larger. Another form of private equity, and I'll talk more about this later, is the crowd. There's an emergence of crowdfunding where private individuals are potentially able to provide equity funding to entrepreneurs, and I'll talk about some legislation that impacts that. Then you've got sort of the classic venture capitalists. So these are folks that go raise money from limited partners. Those limited partners are typically pensions, endowments, wealthy families, and they give money to the venture capitalist. The venture capitalist turns around and says, I'm going to go find early stage companies with a lot of growth potential, and I'm going to try to turn your investment as a limited partner into 3 times your money in a few years. Typically, fund life is about 10 years. So VCs go and invest other people's money in early stage companies. And then you have the angel investors. And the angel investors think about the world similarly to the VCs, but rather than investing someone else's money, they're investing their own hard-earned money. So they're not raising money from a limited partner. They're looking at these early stage companies and investing their own wealth in those ventures. And then, of course, you've got other broader sources of financing. Sometimes Fortune 500 big companies can come along and be a strategic partner. Maybe they help fund some development. Maybe they become an acquisition candidate for your company. You can float your private stock on a public market in an IPO. Certainly the window for that is more limited these days than it was just a few years ago, but public markets are a way to raise money. And then there's some other unique types of funding opportunities. There's been an emergence recently of accelerator programs. I'll talk more about that in a few minutes, but we've got one here in Greenville that was previously called the Next Big Thing. It's now called the Iron Yard, and it's in process now. But if you've heard of Y Combinator or Techstars, that's the type of program that I'm referring to here. Again, I'll say more about that soon. And then there's some other unique ways. I was recently with an entrepreneur who's got a business that is funding prize competition. Some of you may be familiar or read about the X Prize competition to try to fund a contest to see who could provide a private way to fly people into space. And that was funded and successfully, that grant was successfully awarded a couple of years ago. So there's a whole litany of different sources of venture finance out there. But let's try to think back about our framework and that cash curve and think about where those sources of finance tend to play. So with the early stage, the seed stage of a company's life where you're really trying to test the idea, maybe you need a few $1,000s to operate your business at that point. Then you become a startup company, you're really trying to make a go of it. You might need a few $100,000 to a couple of $1 million. In the growth stage, you might need tens of millions of dollars. And then if you're a much more mature company and you're in that really hyper-growth mode or mature mode, you might need tens of millions or hundreds of millions of dollars to grow your business, acquire other businesses, et cetera. So let's map against this where different sources of capital tend to operate. So the bootstrapping method, typically that's going to be the early stages, relatively small amounts of money. Friends and family may come along and help you fund tens of thousands of dollars. Typically that tends to tap out once you reach that $100,000 range. The federal grants start to play somewhere in that $100,000 range, and some are a little bit larger, but grants and public sources of funds can come into play there. This crowd that I mentioned can play in the early stage spaces in terms of tens of thousands, maybe hundreds of thousands of dollars. We've even seen some instances of millions of dollars raised through crowdfunding. If any of you have paid attention to Kickstarter or Indiegogo, some of those platforms are starting to put some significant amounts of money together. Now those are not equity investments. I'll say more about that soon. Those are a unique type of funding where you get some sort of a prize or reward in exchange for your cash rather than equity. But those platforms are growing. The banks come along, again, they're not going to operate on this cash curve until you're cash flow positive and they know there's enough cash coming in to pay the coupon on the debt that they've offered you. Then the VCs come along later, and I'm going to tell you in a minute why they don't invest at the early stages of a company's life. They invest later, once you're in the growth stage. Private equity guys are much, much later stage. They want to see tens of millions of revenue, a lot of EBITDA, a lot of profits before they invest. And then, of course, IPO markets become available beyond that stage. And maybe the Fortune 500s come along and acquire your business at some point. So roughly speaking, that's where people play in this marketplace. But you notice there's a big gap in that startup space. Once you've tapped out the friends and family money, you're not yet cash flow positive, so the bank's not really a viable option. The VCs don't play there. Again, I'll tell you why in a minute. So really about the only funding source you've got if you're in that startup space and you've tapped out of your own resources is angel investors. And again, these are individuals that you didn't already know who bet on you and put their own hard-earned money into your startup. And so we'll talk about how angels operate. So I mentioned that VCs don't invest early, so let me just say a word about that before we move on. This shows you the amount of capital under management in VC firms in the U.S. You can see in this chart pretty clearly where the dot-com boom happened and this explosion of capital that was provided by limited partners to venture capitalists because they saw the profits that they made, and so they gave them a lot of capital. And so venture funds, instead of operating with an average size of $30 or $40 million 20 years ago, have grown to an average size over $100 million. But the incentive for the VCs is not to grow their partnership as quickly as they grow their capital because they make 2% on the capital under management. So as that capital grows and that 2% fee they take out of that capital grows and grows, those VCs have an incentive to grow the capital but not add a lot more people and therefore not do a lot more investments because it's not efficient for them to deploy $100 million in $1 million chunks. They can only sit on so many boards and manage so many companies, so they like to deploy it in $3, $4, $5 million chunks on the low end. So again, if you're an early stage company and you need $1 million, most traditional venture capitalists are not going to be a good source of funds because they've just got too much money to invest at early stages of a company's life. Now we're seeing the venture capital industry shift a little bit. Some of them are starting to come back and carve out some dollars to play in the early space. But broadly speaking, venture capitalists don't invest in startups anymore. Precisely. So John's making my point that if you're in South Carolina and you want venture capital money, you've really got a hard time. This shows you the number of venture capital investments made in the Southeast over the last few years. Not surprisingly, Georgia and North Carolina have a fairly robust venture capital flow. But if you look at us, we're scrapping the bottom with Alabama. And so there aren't any resident VCs here. And it's very difficult to get the attention of VCs. They've got a lot of deal flow in other places. And so if you're in South Carolina, you've got a very, very difficult time sourcing venture capital here. So that's where we turn to the angel investors. The VCs have evacuated this early stage space, so angels have stepped in. And you don't hear as much about angels, you don't read as much about angels until recently. And part of that is because they're much more diffuse. It's a lot easier to identify the 900 or so venture capital firms in the U.S. than it is the 300,000 or so angel investors that are investing in private companies every year. But from a magnitude standpoint, angels invest almost as much money every year as venture capitalists do, to the tune of $20 to $30 billion a year over the last 5 years or so. And certainly that came down significantly when we went through our recent economic downturn. But both the venture class as well as angel funding has rebounded some slowly over the last couple of years. But one of the other interesting things to note from this chart is the numbers on the right-hand side of the page. Again, I told you that VCs have to invest a lot of money at one time because they have a lot of money to manage. So they invest in only 3,000 or 4,000 deals in a given year, 3,000 or 4,000 companies. Whereas angel investors are funding something like 60,000 to 70,000 companies in a given year. So again, your chances of getting funded by VC are very small relative to other sources of capital, particularly angel investors. So angels have started to come together. And they're private individuals investing their own money in startup companies, but they've learned over time, particularly in the aftermath of the dot-com bust, that maybe I'll do better if I get together with other angel investors and pick their brains a little bit about these investment opportunities than if I just do it on my own. So there's economies of scale to that as well. And so you've seen this emergence of angel groups across the country over the last 10 years or so. Now there are about 200 groups around the country. UCAN, the Upstate Carolina Angel Network, is one of those groups. And again, JB and Tim Reed founded the group about a little over 4 years ago in early 2008. So we launched in April of that year. And JB and Tim and others who put the group together decided that UCAN should be a network model angel group. So some angel groups operate like a small venture capital firm in that they have a fund. So they got early commitments from somebody that says, I'm going to invest $100,000 in your fund. And then we have some collective decision-making process for how we invest those dollars. UCAN, however, is not that model. It's a network model. So rather than committed capital up front, we have a process that allows individual investors to make their own individual decisions about every investment opportunity we put in front of them. So once we've been through our process, which I'll describe in just a moment, we pass the hat. And we ask our investors, based on the due diligence that we've done on a company, whether or not they find it to be a compelling investment opportunity. If so, and we circulate somewhere on the order of $150,000 or so, we will put that deal together and invest in that company. We have done deals as smaller than that. $100,000 is sort of the very minimum. We've done deals as large as about $400,000, but our average is about $200,000 or so in the deals that we do. So what kind of deals are we looking for? What types of companies? Like most other angel groups, we are regionally focused for practical reasons. We want to be able to go and see and touch the companies that we're considering investing in, or once we've made an investment, we need to be able to get to board meetings. And so we want to invest fairly locally. But we also need to have a broad enough footprint to give us enough attractive investment opportunities to make the model work over time so that ultimately we make money and can stay in business. So we're focused on the southeastern U.S. For us, that's about a 4-hour radius of Greenville. So Carolinas, Georgia, East Tennessee is our rough footprint. In terms of the stage of companies that we're looking for, we don't invest at the very earliest stages of the company's life. We need to see some evidence that the business has some traction, is going to market. There doesn't necessarily have to be revenue yet, but we've got to have enough indication from the marketplace that revenue should be coming soon. Although everything you can do as an entrepreneur to get to revenue early helps your case. A lot of folks in the venture space will tell you that you're really making a bet on the jockey and not the horse. So the management team is really critical, because most startups are going to find, and I'm sure some of you have experienced this, that you have a great idea for a business and you start off in one direction and think this is what your business is going to look like. But more often than not, when you have contact with the marketplace, you're going to find out that's not exactly what the market wanted. So you're going to pivot, you're going to shift. And so we want to find management teams that have the resourcefulness to be able to make that pivot and adjust to what the market tells them and be able to roll with those punches and be resourceful and make the business grow. So some of that's experience, some of that's trust, making sure that we can trust the entrepreneur to make good decisions in that context. We certainly want them to be passionate about their idea. This takes a lot of blood and sweat and tears. So we want to know that folks that are in this business are in it and are dedicated. So we spend a lot of time thinking about the management team and or the advisory team that surrounds the entrepreneur. In terms of market, people often ask us, well, what types of industries do you like to look at? And the answer to that is we're fairly agnostic about that for two reasons. One is because our membership is very diverse. We have folks from a wide variety of backgrounds that can help us look at different deals from a number of different types of industries. So we're not so much interested in the vertical, we're more interested in the characteristics of that marketplace and the company in it. So does the company come with some sort of defensible competitive advantage, whether that's a technology or a business model or relationships? Is it scalable? That's a key one. I'm going to show you why some of the underlying logic for this in a moment, but we need a company that can scale to $20, $30 million of revenue within just a very short period of time, 3 to 5 years, in order to make the math work for this model to be profitable. So it's got to be scalable, and it's got to be capital efficient. Again, I told you we don't have a lot of venture capital resources here. We invest a couple $100,000 at a time, so we like to find businesses that can reach those really high revenue marks without tens of millions of dollars in capital to get them there. So they've got to be capital efficient to be a viable candidate for a group like ours. And then in terms of structure, I've been asked, do we make loans? What do we do? We tend not to make loans because we're operating in a very risky space, which I'll underscore in a second. And so typically debt doesn't offer a high enough return to make it worth your risk as an investor to invest in an early stage company with debt. So we like to buy equity in the company, and we hope that equity is going to grow, and somebody's going to come buy that equity from us and from the company at some point in the future, typically through an acquisition. And so when we're looking at a deal, roughly speaking, we need to believe that company can return on our investors' money something like a 50% rate of return. What you're thinking to yourself, that is extraordinarily high. How in the world do you get to a 50% rate of return on a company? Well, that's why this is a very difficult business, and that's why you don't see a lot of folks being able to get funding in this space. But let me explain where that number comes from so you have a little bit better context to put it in. But hold that thought for a second, I'll come back to it. Let me tell you this first, in terms of process. So if you're interested in getting in front of our group, here's how it works. We have a multi-step process that starts with an application. You simply go to our website, which is upstateangels.org. You can find a link that will take you to a platform we use to manage our deal flow. That application will tell you basically what we need to know from you to be able to determine if your deal fits our profile. So we'll ask you for that application. I'll review that, spend some time looking at the deals that come in. I usually see somewhere on the order of 15 to 20 deals a month. I will pick 3 of those each month to come before our screening committee, which is a subset of our members who take a look at that deal. They'll select one of those companies out of that screening bunch to go before our full membership, which meets once a month. The full members will hear the pitch from the entrepreneur. If they like the company and think there's an opportunity, then we'll vote to move into what we call due diligence. We're going to spend some time peeling back the layers of the onion a bit, trying to get a better handle all the inside scoop on the company, understand its markets, its competitive advantage, its management team, its markets, its customers. We'll typically spend a month or two going through that diligence process. It's a lot of folks to coordinate, so it does take some time. And then at the end of that process, we'll issue a report to our members. We'll pass the hat, as I mentioned, and if we've got sufficient interest to invest, then we'll put the investment together. So in terms of timing, it takes time to go through that process. Again, we're dealing with a distributed network of folks, so it's not a centralized decision-making process, so it does take some time. We tell folks that it's going to take, once you get started and you get selected for the screening process, plan for 4 to 6 months. We can sometimes move more quickly than that, but it's not very often that we do. So plan for 4 to 6 months, and because we're only taking 3 deals a month at the screening level, if you're an entrepreneur looking to get funding from an angel group like us, you should be planning a year in advance, not just 4 to 6 months in advance. And I mentioned that it's a difficult business. I said I see 15 to 20 deals a month, so we're seeing a couple hundred deals a year, and we'll invest in a handful. So the investment rate on the deals that we see is only about 2 to 3%. So I don't say that to be discouraging, but just to let you know, this is a difficult way to get funded as an entrepreneur, and it's got to fit some very specific parameters in order for it to be an attractive deal for us. So now let me come to why the rate of return hurdle rate that we have is so high. This is some data taken from angel groups in a study conducted a couple of years ago. And what you're seeing on the vertical axis is the percentage of investments that the angel made and had an exit on, whether that's positive or negative. And on the horizontal axis is the return on investment to the investor. So you can see in this first bar that over half the deals that the angels did lost money. And about half of those lost all the money. So as an angel investor, right off the bat, you have to assume going in that half the things you invest in are going to lose money for you. So what you want to see is that on the other end of the spectrum that you've got some percentage of your deal flow that can hit a home run. And in a home run, we mean 10 times your money. Now, you know, the rate of return has to do, time as a factor in that equation. So if you can make us 4 times our money in 3 years, that's the same rate of return as 10 times our money in 5 years. So we think about timing, and we're looking at the potential return on these investments and when it might become an attractive acquisition candidate. Because we know that only a fraction, less than 10% typically, of the deals that angel investors do hit a home run for that investor. But the theory is that you want the home runs to make up for the losses. You'll have some singles and doubles in the middle. But at the end of the day, over time, if you're diversified and if you're patient, then you should be able to generate a venture class return as an investor in this space. Certainly not a guarantee, but that's the way the portfolio theory works. The other thing to note if you're an angel investor is the lemons sour faster than the plums ripen. So the losers tend to lose more quickly than the winners win. Average failure time is about 3 years for deals that fail. Average time to home run, if it's a home run deal, is 5 years or more. So you've got to think about those metrics if you're an angel investor. And as an entrepreneur, you need to understand that angel's perspective as they're making their investments, because this is the reality of the math that they have to deal with. And while we love to keep doing this as angel investors just out of the goodness of our hearts, if we don't make money on the investments, then ultimately we run out of capital to do this with. So we have to think about these things when we're making our investment decisions. A quick update on where UCAN was the last time I talked to you. In terms of deal flow, we had seen about 270 deals. About a third of that, just over a third of that, came from inside South Carolina. In terms of investments at that point, we made 6 investments. Half of those were in South Carolina. And in terms of dollars, we'd invested about $1.5 million in the last time I was with you. And about 60% of our dollars had stayed in South Carolina. I mentioned why we have to go outside our borders to make sure we have enough viable deal opportunities to keep the model working, but it's encouraging to see that we started out investing at least half of our deals and our dollars in South Carolina, and since then it's gotten even better. So as of today, we've seen over 800 business plans. Still about a third of those, just over a third, come from within the state, but our investments are up to now 22 companies have received an investment from UCAN. Over 60% of those companies are now in South Carolina. That's 14 companies out of the 22 are in South Carolina. We've invested a total of almost $6 million, and almost 80% of those dollars have stayed in the state. So that's encouraging to me that our deal flow has been sufficient to allow us to put money to work in viable candidates in South Carolina. So if you look at it over time, we're investing about $1.2 million a year in about 5 new companies every year. We'll also do follow-on investments in companies that have previously raised capital from us. It's almost always the case that those startups are going to need more capital than just that first round, so we have been able to support our portfolio companies with follow-on investments. So we're on track this year to have potentially a record year, but we certainly should be in the range where we were in 2010 and 2011. So that's also encouraging. Quick snapshot of our portfolio. I mentioned we've got 14 companies in South Carolina. We've got 3 in North Carolina, 4 in Georgia and Atlanta, and 1 in Tennessee. We're getting a little short on time, so I'm not going to go through all of these in detail, but let me just highlight a few things. One of the first investments, or in fact the very first presentation that was made to UCAN was CeeLo Technologies, which of course got it started in a venture. Michael Bullock, I'm sure a lot of you have read that story. CeeLo was acquired by Lab 21, which is now in the next building, so this has been a neat story about the process and the ecosystem for entrepreneurs taking a university technology out of Clemson, starting a business, growing it, being acquired, and now that company is housed in the next center and growing and doing really well. Sable Medical was a company in Charleston we invested in a couple of years ago. We had our first liquidity event with that deal where we made about 3 times our money in 4 months. So if you do the math on that rate of return, it was about 2,200%. So we'll take those as often as we can find them, but that's the only one we found so far. So if you see another deal like that, please let us know. They were acquired by a company out of Switzerland. Cerebellum's a fun company that we've recently funded. These guys have developed and have just launched the world's first digital rear view mirror for bicycles. So if you go to the Cerebellum website, you can now buy the hindsight, which basically is a camera that you put on the seat post of your bike facing backwards, run a cable to a head unit on the front of the bike, and you can see what's behind you without turning around. It's amazing what that can do for you if you ride a bike and not have to worry about turning your head over your shoulder. They've got some really interesting traction. Got a call from Greg LeMond the other day, interested in the product. So they're doing well, and it's going to be exciting to see where these guys go. I mentioned accelerators. The next big thing is a Techstars affiliate. I don't have time to tell you a lot about Techstars, but it's a way to take entrepreneurs, about 10 teams of entrepreneurs in a short amount of time, about 3 months, surround them with technology folks and mentors that help them start a business. They've since rebranded themselves as the Iron Yard. They've got 10 companies going through that process right now here in Greenville, tapped into venture networks and early stage networks around the country. Some really exciting things happening there. They're going to have a demo day in September to show you the companies and the products that are launching from that business. So stay tuned. I think that's going to be a really exciting thing for Greenville when these guys launch, and some of the folks from the best names in early stage investing from around the country will be here for demo day. You've probably read about Proterra. UCAN, this is not a typical investment for us, much more capital intensive than a deal that would typically make sense for angels, but they needed some bridge financing when their previous financing fell through. They're now at over 100 employees and growing and gaining traction in the marketplace, so that's exciting. Another one you'll be hearing more about soon is American Titanium Works. They've been in the news for a long time trying to build a titanium plant in Lawrence County. They ran into some hiccups as the capital markets tightened in the recession. The capital markets told them to go and de-risk some of the things that they were doing by signing up customers and getting some construction risk taken out of the deal. They've done that. So we expect them to go to market to get the funds to build the plant in the near term. And so we help them with some bridge financing to be able to do that. So we're excited about that and hope that that's going to be a really big, important deal for the Upstate here in the next couple of years. So I mentioned, let me just spend the last 2 minutes I've got telling you about what's on the horizon, some things that we see coming that will impact the landscape for early stage finance going forward. Continued disruption in the VC market. Basically the only VCs that are raising money from limited capital, from limited partners now are the ones that are really good, which is only about the top 5 to 6% of venture capital funds. So eventually we'll have fewer venture capital funds out there. The ones that are out there will be bigger, so we'll to some degree exacerbate the problem that I described earlier. But we also see some innovation in this space, and you see smaller funds coming together, and hopefully that will, on the other hand, help us. I mentioned the accelerators like Techstars and the next big thing. There's a proliferation of these things around the country. To some degree, there'll be an overreaction and probably too much of that in the marketplace, but at the end of the day, the more entrepreneurs we can encourage and ideas we can test with limited amounts of resources in a quick fashion, the better chances we have of entrepreneurs creating wealth for the world. Another way they're doing that is the adoption of lean startup methodology in the startup space. I'm sure a lot of you are familiar with lean methodology in the manufacturing space. Steve Blank and Eric Reese have applied that to the startup world, and some really powerful stuff that's going on the West Coast and making its way this way. So if you're interested in startups, particularly technology startups, I encourage you to look into this topic. They're also in the process of starting to think about how it applies to Main Street entrepreneurship, as they call it. So I think some really powerful learnings that will, again, allow us with limited resources to help entrepreneurs create wealth. The Jobs Act is supposed to do a lot of things. They're still in the midst of trying to write the rules on this. There's a whole bunch there. I don't have time to describe it. The crowdfunding piece probably gets the most buzz. It's not clear at all whether that's actually going to work and allow non-accredited folks that the SEC says you have to have $1 million in net worth to invest in private companies. This law would say you can do that as an individual that's not accredited. Not clear yet if those rules are actually going to make this solution workable, but potentially it's going to be a good thing for entrepreneurs. But you got to understand, if you're an entrepreneur, the impact of raising crowdfunding and what that will do to your chances of raising angel and venture money down the road. Then finally, we need more angels supporting entrepreneurs in South Carolina. I've talked about the difficulty of accessing capital here. We're trying to get some legislation passed in Columbia to create an incentive to get angel investors to put money into this space. Because it is risky, we want to give people a chance to mitigate their risk through a tax credit program. We nearly got it passed last year. We could use your help getting it passed next year. And then we certainly want you to send, in terms of ways you can help us, we want you to send deals our way. We want those entrepreneurs that continue to create wealth. If we want to get out of this malaise we're in economically now, it's going to come through entrepreneurs and innovation. So send us entrepreneurs and deals. Investors, we're always in need of investors that are willing to put some of their hard-earned capital to work in this space. We need affiliates and sponsors. We're going to roll out a new program for that this fall. So if you're interested in supporting this space, whether you're an individual investor or you're a business, we have ways for you to help us do that, to help us help entrepreneurs. So certainly I can get you more information about that. And then again, we'll ask for your help with the legislation we hope to get passed. There are about 26 other states that have angel tax credit programs, including Georgia and North Carolina. So like on most things, we're behind them. We're trying to catch up, so we could use your help with that. So I'm out of time. Let me say thank you again, Phil, for the opportunity to be here. I'm happy to take questions if we have a minute or two.
Yeah, well, first off, a round of applause is in order. Let's take a couple of questions if we can.
Yes, sir.
What's it take to be an investor? Money, but how much?
So again, the SEC says you got to be accredited, which is $1 million in net worth or $200,000 of income as an individual, $300,000 as a couple. If you meet those requirements, then to join our group, it's $2,500 a year, which gets you access to all the deal structuring and the education. And most of our folks tell us that the $2,500, even apart from the investments, is worth it just from the education and exposure you get to the ideas and the entrepreneurs and the other investors in the room. So $2,500. Yes, sir.
How's your success rate compared with the overall metrics with your weed out system, the system going through and your process? And you don't have to give me, just significantly better, a little bit better, or just right in the average.
In terms of the actual investments we make, we look pretty much like most of the venture and angel industry. That 2 to 3% investment rate is pretty typical. In terms of outcomes on the back end, we're still young enough where it's hard to benchmark us against long-term data because we're only 4 years in. And of course, we didn't make all the investments day one, and there's a 5-year hold period on most of these. So we've had 2 acquisitions I showed you. We have had 1 failure in the portfolio so far. It was a software company out of Atlanta. We're actually trying to revive the technology there. The technology is good, just the business didn't work out. But that's, you'd expect half the things to fail, and so far we've only had 1. So, knock on wood, we'll do okay. Yes, sir.
Would you normally expect a position on the board?
Good question.
And associated with that, is there a proportion of equity that you insist on controlling?
Great question. So in terms of deal structure, typically for an angel round, which broadly speaking is somewhere typically between $250,000 and $750,000 in the round for an entrepreneur, you'd typically expect that to be 20 to 40% of the equity in the business. We typically won't be all of that money unless it's on the low end of that range. So typically we're in a syndicate with other investors, whether it's other angel groups or other private individuals, and depending on how that syndicate comes together determines how the board seats get allocated. We are always going to expect the angel investors to have board seats, typically 2 on a 5-member board. And if we're a lead investor, we're going to take 1 or 2 of those seats. If we're not a lead investor, then we'll expect other angel groups or other investors to take 1 or 2 of those seats. Does that help? Yes, sir.
You must have answered them all. Awesome.
Thank you.
Round of applause again. Thanks, Matt.